At Rule 1, we believe that value investing has evolved. We believe that it is better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price. And that really explains the transition that Warren Buffett made coming from Ben Graham, where he started to look for these compounding, amazing companies where he could buy in one time and let that money ride for the next 30 years. And so value investing to a Rule 1 investor and the principles that Phil has built upon off of Warren Buffett is to not only just find these long-term compounders, but find these long-term compounders where you can put your values behind the company and want to see those companies flourish for the next 10, 20 years in the world. Most of the companies that he invests in are very simple, and he has a huge amount of focus on buying companies relative to the free cash flow or earnings that they're making, buying very cheap companies that he knows are going to be bigger and better in the future. And those companies hopefully are going to be the companies that make the world a better place and make us rulers a lot of money.
When what we really want to do is we want to set aside money that will by itself compound. Otherwise, if this company, let's say, does well for 4 or 5 years and then has a problem, then I've got to take my money out. Mm-hmm. I've got to find another compounder.
Yeah, it's more work.
It's more work. And I would much rather leave it there. Mm-hmm. Just let it compound away. I mean, the classic example of a low growth company that Buffett's been in forever is See's Candy that he bought for $25 million. And now See's Candy puts $65 million a year into Buffett's hands to be invested. And it's just like, man, how about if that, and that was, you guys, that was 50 years ago that he bought that company. He bought American Express 50 years ago and he still got it. It's still compounding. And it's just like, man alive, the power of that, just to leave it alone is so wonderful. But for all the work you don't have to do in the future 50 years because you bought this wonderful compounder, you got to do a bunch of work up front in order to buy it.
So Rule 1 believes that in the current economic climate, that value investing is the right approach. And I mean that in the sense of starting with finding really, really wonderful companies that have the competitive advantage and what we call a moat that will carry them through these tough economic times, carry them through high inflation. And what we hope is find companies that will emerge stronger companies out the backside as we come out into the next economic growth cycle. And why value investing is such a great approach to tag on to finding wonderful companies is that in a tough economic climate, you can often find really amazing companies where the price has fallen down into on sale value prices. So for a Rule 1 investor, this current period is a very exciting period of time to be looking for the next investments that are going to make you money for the next 10, 20 years.